Welcome to today's market report.
The gauge of global equity markets edged higher on Tuesday, while 10-year US Treasury yields eased back from the 3% level as investors remained cautious, expecting the Federal Reserve to hike rates by the most in a single day since 2000. In a sign of the challenge the Fed faces in fighting inflation, data showed US job openings hit a record in March as worker shortages persisted, suggesting employers may need to raise wages. Investors expect the Fed hike rates by 0.5% point on Wednesday and to detail plans to reduce its $8.9 trillion balance sheet. The US Central Bank raised its policy interest rate by 25 basis points in March. Major stock indices in Europe rose, as did Wall Street's big equity benchmarks. MSCI's gauge of World Index rose 0.4% and the Pan-European Stock 600 Index closed up 0.53% after surviving a flash crash in Nordic markets on Monday caused by a Citigroup sell order trade. The Dow Jones rose 0.17%, the S&P gained 0.48%, and the Nasdaq added 0.16%. The Bank of England is expected to raise rates on Thursday for the fourth time in a row. Asian equities were mostly steady in holiday-themed trade, with both Chinese and Japanese markets shut. Germany's benchmark 10-year bond yield rose to 1% for the first time since 2015, before retreating as caution set ahead of the anticipated US and UK rate hikes this week. The yield on 10-year Treasury notes was down 4.2 basis points to 2.954%. The dollar fell against a basket of major currencies as investors weighed how much of the Fed's expected move to hike rates this week and beyond was already priced in. The dollar, which has been supported by safe haven buying on worries over the economic outlook, stayed just below the nearly two-decade high reached in April, and the euro steadied above the lowest level in more than 5 years hit last month. Amidst an upbeat market mood, the GBP/USD posted modest gains despite retreating from daily highs around 125.67 ahead of monetary policy.
This is today's market news. Thanks for listening. We'll see you next time.